I think we've got to pick it off where James Gorman left it off. He's saying the worst is over. Let's look ahead to Goldman, another big investment bank. They're guiding for a 25% decline in equity and fixed income trading. Do you believe that the worst is what we're going to see in this quarter, and it's only upside here for Goldman and other big investment banks?
Yeah, I mean, I think that's probably a fair assessment. It looks like the trends are improving into the back half of the year. I think, to me, from what I'm seeing, it feels like maybe we need to get to 24 before we see a real pickup in activity, especially in the financial space where we, spend most of our time. It looks like we're going to need to get into that, time period before rates adjust and where, multiples around deals can maybe be, more where they used to be. So I think we need that move into 24. We need more normalization in the economy before we see that pickup in M&A.
So when you say when you need to see rates adjust, exactly what does that mean?
Yeah, I mean, I think, in the financial space, if we can see rates move lower or at least stabilize, we can kind of understand how all the math around M&A accounting can work for a financial or for a bank in particular. And again, just that stabilization, just knowing where we're going to be 6 months from now will give people a lot of peace of mind.
So when you say lower, just very quickly, how many more basis points lower? Because right now I'm looking at the 10-year. I believe we're at about 3.74. So how much lower do we need to get for it to be stabilized in your mind?
Yeah, well, I mean, we need, the Fed to decrease rates at some point in time. So I'd like to see, 100 basis point decline, I think is kind of around what the forward curve shows in 24. Some steepening of the curve, I think, would help. Obviously, right now, the inverted curve is troublesome for the economy in general.
All right, a lot to watch. Let's talk more broadly about financials. Net interest income, that's the difference between interest earned and interest paid. It's been a key metric for a lot of these banks. With so many people taking their money to chase higher yields in either bonds or money market funds, what have you seen so far?
Yeah, I mean, it's been negative, obviously, as we expected. I would say coming out of the Morgan Stanley conference, kind of mid-quarter, there was a lot of fear that negativity could kind of persist almost indefinitely. It seemed to be the feeling from some in the market. But what we've seen so far through this earnings season is yes, there is pressure on funding, but the actual balances seems to have stabilized, which, gives banks a good central place to be to kind of continue to earn and grow over time, just not as much as we would like and not as much maybe as they earned 12 months ago.
All right, so obviously we have a lot of other regional banks set to report. Are you expecting a lot of write-offs when it comes to commercial real estate loans? That's one thing that a lot of people are looking at in the upcoming Goldman report as well.
Yeah, I mean, we really aren't. We haven't seen many cracks yet on the credit side. That's kind of this overhang headwind that we continue to face when we speak with investors, that there's this fear of what's looming in the back half of the year. Or now maybe it's 24. It seems to be this never-ending fear. We're just not seeing it yet. Banks, are seeing one or two loans, maybe an office loan here or there, but nothing more systemic that really causes us to think, a credit crunch is imminent.